Hello, everyone. Welcome to the first video of Chapter 3. We've gone through the first two chapters where we covered a lot of rules around who pays taxes, when is the money due, how do we refute it. Now that we're into Chapter 3, we're going to get a bit more into the math side of taxes. And the focus of this chapter is income or loss from employment. Employment is a big source of income. Your work will pay you wages and salary, but sometimes that's not all they give you. So we're going to look at some of the things you might get from work and how do we include it in our employment income. So we've established that employment income is a source of one's labor. For each employment, we'll determine inclusions and deductions for that employment. We are not permitted to deduct allowable employment expenses from one source of employment against another source. So if I have a job that requires, a home office, so I have some home office expenses, but on the weekends I work at a restaurant, I wait some tables. I can't deduct my office expenses from the job that doesn't use my office. So those when I wait tables, I'll have a bit of employment income, maybe some tips that will be reported separately. And then my office work that I do from home, I'll report that income. And if there's enough to warrant it, I might be able to deduct certain office expenses. So whenever we're discussing income amounts and deductions, it always has to apply or relate to the income we're talking about. Um, Employment income in the Tax Act, Section 5 is description of receipts considered to be part of an employment income. Section 6 expands list of inclusions. Section 7 talks about employer provided stock options. We will discuss stock options before the end of this chapter. And then Section 8 discusses specific deductions. So I think there is some employment deductions that we discuss right at the end of this chapter. So, what is considered employment income? Income comes from an office or employment. Subject to this part, a taxpayer's income for a tax year from an office or employment is salary, wages, and other remuneration, including gratuities received by the taxpayer. Anything that I receive by virtue of my job. If I work at a bank and I get a bank loan, banks offer loans to everyone. There's not going to be anything about that related to my employment. But if the bank loan gives me a preferred interest rate, so that loan doesn't cost me as much money because I'm an employee, they may not have given me income, but they saved me expenses. My economic outcome is still beneficial. And the reason I got that preferred interest rate is because that's something employees get. The general public doesn't get that. I have that benefit because I worked at that location, that bank, or that employer. So the money I've saved can be considered to be a benefit that I've received through my work. So that could be added to my employment income as part of my remuneration package, as part of my, that incentive package that the banks provided. So it talks about the taxpayer, that's you, the individual employee, or me if I'm the employee. And the reference to office extends rules of employee taxation to other individuals not usually considered employees. So judges, members of parliament, they do refer to their office or office space. Reference to employment refers to the position of an individual in the service of another person, contract of service. So employment is I'm working on behalf of an employer. This is different than if I'm working for myself. It helps define when am I a business owner and when am I an employee. We include an income, gross amount of remuneration included in employment income before any withholding. So if you have a pay stub, if your pay stubs for the year, your gross income $60,000, and you have deductions taken from it, CPP, EI, taxes, your income inclusion is the gross amount, the 60. Even though because of my source deductions, maybe I only got $48,000 to actually take home. That $12,000 difference will be dealt with in my tax account and my credits, but my income is still the full amount, 60,000. Only amounts received in a given year are included in income. Businesses deal with accrual basis of accounting, so they include in their income anything that is owed to them. But employment income is different. It worries about when was cash paid. So if I have a paycheck in October for time in October, that's included in the 2024 year. I got paid in the year. But let's say it comes to the end of December and I'm after December 25th, I've worked a handful of days, but I don't get the paycheck for those days until January 2026. Well, that income's going to be next year, 2026, because that's the year I got the money. So when it comes to employment income, they're much more concerned with cash basis. When was the cash actually received? Amounts received as a result of employment, irrespective of who pays the amount, are included in income. So I got tips for the restaurant. Now, my boss didn't give me the tips, a customer did. But customers gave me tips because I work at the restaurant. The customers don't come in and hand out dollars to people who sit at other tables. They give tips to the wait staff. So I'm receiving that by virtue of my job, irrespective. It doesn't matter who gave me the money, but that I got the money for that job. So it's part of that employment income. Cash basis and planning. I mentioned about the accounts amounts received has to do with timing. Income is taxed when received. It's reported on a cash basis, not accrual. This allows a tax planning opportunity. If I can time, let's say my work's giving a bonus. We're going to do a Christmas bonus. And I say, well, you know what? Could I have my Christmas bonus paid a couple weeks later in January? That might help me out because, or that might be beneficial because that income is going to be received in 2026. So it's not going to be reported and the tax isn't going to be paid on it until I file that tax return in 2027. The business will deduct the expense in 2025. So the business will deduct the expense in 2025 when it's accrued, but I'm not going to include it in my income until I received it in 2026. So that timing difference between how businesses record income and expense and when people report employment income allows us to defer taxes for these small periods, this 1 year deferral. There is a limit on this deferral. So if someone claims that there's a bonus at the end of the year, there's a year end, we've declared a bonus, the business expenses it, but they have to pay it within 6 months or 180 days. If they don't pay it by the 179th day, they're no longer allowed to expense it in 2025 when they recorded it. They'll have to add it back to that corporate income and they'll expense it when they actually pay it in the next year. So yes, we can have the deferrals, but we can only have defer that income for a little bit of time. And it makes the difference between getting paid this year or next year. But they have to pay it within 6 months. It's to keep people from just continuously declaring bonuses and never actually paying it out, just hanging on to that money in their business forever. So they have to pay it out because they get this income needs to be reported and tax needs to be paid on it. There is a special arrangement called a salary deferral arrangement. This rule applies where the deferral exceeds 3 years. The deferred amount is included in employee's income in the year service is rendered. So I will work for a business. They will declare the income, they'll expense it. I will report it in income this year, even though they're not going to pay me for 3 years. Now, why would someone do this? Someone would do this if they expect in the next 3 years their income's about to take off. If someone works in sales and they're like, oh, I've got a really good customer base this year, but I think when the commission pays out in a couple years, it's going to be really high. I'm going to have a really high income. Well, if I'm willing to defer that salary a couple years, I can declare it now and pay it my lower tax bracket instead of waiting until I get all that money at one time. So as long as it still applies to work I did this year, we'll still report it all. I'll still pay taxes, but then I won't have to report the full amount when I receive it in 3 years. So here we go. So a standard bonus, you can declare it. The employer deducts it when accrued, and the employee includes when received as long as it's paid within 180 days. So 179 or less. The other bonus is something that's paid over that deadline. The employer deducts when paid, the employee includes when received. So we waited too long, so we lost that standard arrangement. Now it's waiting to see when the bonus actually gets paid out. And the salary deferral is employer deducts when accrued, employee includes when service is rendered, but the payment is not going to be made for 3 years. So, for example, on July 25th, 2025, Martin declares a bonus of $100,000 in favor of one of his employees, Roger Jones. Martin Limited's year end is July 31st. So they had a good year. Right before July 31st, they declare a bonus. So they'll be able to expense that $100,000 now, save the corporate taxes on it now, and Roger won't have to include an income until it actually gets paid out. And July 25th, 6 months is just into January. So we might be able to push that $100,000 of income to Roger's next tax year. But what if it's not paid? Yeah, so if the bonus is paid after December 31st, but before January 28th, the deduction for the employer still occurs in 2025. The employee includes the bonus income in 2026. If it's paid after January 26th, we went over that 180-day deadline. We went over that 6-month deadline. So Martin Limited's next year, the employer will deduct the bonus when paid in 2026. So if the employer's already filed their taxes, assuming they're going to pay this bonus, they filed for income less than what was there. So they'll have to go back and refile that return to put that money back into that tax year. They will pay an increased tax bill, potentially some interest as well for the timing difference, and they won't be able to get that deduction back until they physically pay out the bonus. And the employee includes the bonus when received. So the employee's is cash basis in either case. If not paid within 3 years, the employer deducts when declared, employee includes when service is rendered, and can just wait until that money gets paid out in 3 years because the taxes have already been dealt with. So going to that example or the exercise, Odakinyi has a September 30th tax year end. On August 1st, the company declares a bonus of $100,000. To Mr. Odakinyi, an executive employee, the bonus is payable and paid May 1st, 2025. So that is that's 9 months later. Describe the income tax consequences of this bonus to both Odakinyi, the company, and Odakinyi, the person. How does the answer change if it was paid in October? So how we have this is the bonus was declared August 1st, paid May. The year-end date is September 30th. I think that's in the question. Yeah, September 30th tax year end. It was right in the beginning. September 30th was the year end. So for them to treat it as a standard bonus, they would have needed to have paid it by March, and they missed it. So the employment income, Odakinyi is going to include it in his income when paid either way. The only difference comes up for the company. Because they didn't pay within the deadline, the expense amount is expensed in fiscal 2025 because 2024 was the year. Yeah, in August 1st, 2024. So they missed the deadline, so they can't expense it in 2024 when they declared it. They'll have to expense it in the next fiscal year because they missed the deadline. So that expense will have to be added back to August and deducted in May. If they had paid it right away in October, just after the year end, then that's not going to be a recorded expense until fiscal 2020. The expense will get deducted in 2025. Yeah, Yeah, after the 2025 year will be expensed in fiscal 2026. Now, if it's paid in 2025, it was received after the 2025 year end, but it's still expensed in that current tax year. It's still expensed for October 30th, 2024, because it was paid out within 6 months of its declaration in August. So that was just a small hiccup on that number. I will be sure to upload this updated spreadsheet. Okay. Do I want to keep going with some employment? I'll do the next couple slides, and in the next video, I'll discuss employee versus self-employed. So employment losses. We talk about employment income, but if some employment's allowed to have expenses, it could come about that maybe for the first bit of my job, especially if I'm in sales, maybe I have some customer deductions, some expenses, but I haven't gotten any commissions yet to make up for it. So I have some losses. Income means a positive or nil amount. Loss means deductions for a source of income exceeds income amount. Income from a source is included in Income Tax Act 3. Loss is included in 3D. The rule is necessary, otherwise employment losses would be ignored. So what it is saying is employment losses are more rare than business and property losses. But if I have an employment loss, I need to be able to declare it. So my income will be positive or nil, but those employment losses can either hang around until I have employment income next year, or I would be able to apply that employment losses against another type of income if I have, say, some business income this year. Assuming I don't have a business, I just have a job. My first few weeks, I got hired in December. My first few weeks, I have some expenses. Those losses will sort of be hung on to, reserved, until I start making income I can apply it against. So excess employment deductions from one employment cannot be deducted against a different employment. The net loss can be deducted in the year if other sources of income available. Otherwise, it's a non-capital loss. So if I have some business losses, I can apply my loss of employment again, business income. I can apply my employment losses against it. Otherwise, I just have to hang on to those losses until my employment starts earning income. Okay, so that's our first video. I'm going to end it there. When I come back, I'll have a larger conversation regarding employee versus self-employed independent contractors. Thank you for your time. See you in the next video.